Imagine looking at the oldest bank in America, right? An institution founded by Alexander Hamilton like 240 years ago, and realizing it's secretly operating like some multi-billion-dollar Silicon Valley AI startup.
Yeah, I mean, that is exactly what just happened on Wall Street. It's a profound shift.
It really is.
We're so used to these heritage banks just relying on their history, slowly grinding along. We rarely see a 2.5-century-old firm completely rewrite its own DNA to function at the bleeding edge of exponential technology.
Right. But when you look at the raw data, that is the undeniable reality. So, welcome to today's deep dive. We are thrilled to have you with us today.
Absolutely.
And today's material, it comes directly from the Q1 2026 earnings report and the call transcript for BNY, which you might know formerly as Bank of New York Mellon. And this is dated April 16th, 2026.
Yeah, and it's a dense stack of documents, but the underlying story is genuinely fascinating.
Oh, for sure.
I mean, we are looking at the foundational plumbing of the U.S. financial system completely reinventing its operating model in real time.
Okay, let's unpack this because our mission today is to figure out how this, 240-year-old institution is somehow defying gravity.
Right.
They are absolutely smashing Wall Street expectations, and they're doing it by transforming into an artificial intelligence and digital asset powerhouse.
Which is wild.
It's totally wild. But before we get into the futuristic tech, we have to establish the sheer financial reality that forced the market to, do a double take.
Yeah, let's start with the baseline numbers from this Q1 report because they're staggering for a bank of this size and maturity. Their earnings per share hit an actual of $2.24.
Which blew past the consensus estimate. I mean, Wall Street had them pegged at, what, $1.94?
Exactly.
That is a 42% year-over-year increase. And revenue hit a record $5.41 billion.
That's it.
Right. But as impressive as those top-line numbers are, there is one specific metric in this report that really caught my attention.
Oh, I know what you're going to say.
They achieved 833 basis points of positive operating leverage.
Yeah, that's the one.
Let's pause there because I want to make sure we truly understand the mechanics of that.
So positive operating leverage simply means your revenue is growing faster than your expenses.
Okay.
But to hit 833 basis points or, 8.33% is an incredibly steep climb for a mature legacy bank.
Right, because normally to grow revenue by that much, a traditional bank has to hire thousands of new employees or open new offices, right?
Exactly. Or spend billions acquiring another firm. But BNY is essentially scaling their massive income without proportionally scaling the costs that usually, drag that income down.
Wow. And the result of that efficiency is a pre-tax margin of 37% and a ROTCE of 29%.
Which is huge.
Wait, for anyone who doesn't spend their weekends reading, dense banking regulations, what exactly is ROTCE and why is 29% such a big deal?
Right, yeah. So ROTCE stands for Return on Tangible Common Equity.
Okay.
It's basically the ultimate scorecard for how well a bank's management uses shareholder money to generate pure profits, stripping out all the accounting fluff and intangible assets.
Got it.
For context, many major banks are thrilled to hit a ROTCE of 12 to 15%.
Oh, wow.
Yeah, so pushing 29% is elite territory. It signals that every dollar of actual capital they hold is working incredibly hard.
Hard enough that they just rewarded shareholders with a brand new $10 billion share repurchase program.
Not too shabby.
Right. But I really want to dig into why all this cash is flowing through their doors in the first place.
Yeah, it's an important point.
The CFO, Dermot McDonough, he noted this surge was driven by elevated liquidity and specifically a massive influx of non-interest-bearing deposits. So why are the biggest players in the world suddenly parking so much cash at BNY without even asking for interest on it?
Well, it comes down to the macroeconomic environment of Q1 2026. We are seeing shifting interest rate expectations, significant geopolitical tension, and just general market uncertainty.
Makes sense.
Yeah, so when the waters get that choppy, massive institutional investors like pension funds, sovereign wealth funds, they aren't looking to squeeze out an extra 0.5% of yield.
Right, they're not chasing pennies.
Exactly. They are looking for an absolute safe harbor to park their cash while they figure out their next move.
That makes perfect sense. And looking at their diversified revenue streams, the CFO pointed out that their revenue was almost perfectly balanced, like about 50-50, between fees generated from holding those balances and fees generated from transaction volumes.
Yeah, it's very intentional.
It makes me think of BNY as this massive, industrial-grade, all-weather tire.
Oh, I like that.
Right. It grips the road perfectly if the market is cruising smoothly and asset values are just naturally rising. But if we hit icy volatility and everyone is panic trading and rebalancing, that tire still grips because they collect fees on all that frantic transaction volume.
That's actually a great way to put it. And to stretch your analogy a bit further, it isn't just about the tread on the tire, it is about the suspension system underneath it.
Ooh, okay.
BNY oversees $59.4 trillion in assets under custody and administration.
Wait, 59 trillion?
Trillion, with a T.
Uh-huh.
That is roughly 20% of the world's investable assets.
That is unfathomable.
It is. And that massive cushion is what absorbs the shocks of the market.
So if you are listening to this and wondering why a seemingly dry banking metric like operating leverage or deposit volume matters to your own portfolio, this is exactly why.
Absolutely.
They are the actual plumbing of the global financial system. When a bank holding 59 trillion sees record sales and shifting deposit behaviors, it gives you a direct, unfiltered read on how the biggest money on earth is reacting to global instability.
Yeah, they're the ultimate bellwether.
But that brings up a massive logical gap for me.
What's that?
If they're handling more volume and capturing more deposits than ever before, how are they doing it without their expenses skyrocketing?
Right.
Because you don't get 833 basis points of operating leverage just by cutting the corporate coffee budget.
No, you definitely don't.
The answer taking up a massive portion of this earnings call is a multi-year, multi-billion-dollar deployment of artificial intelligence.
Yeah, and what's fascinating here is the sheer scale and timeline of their commitment.
How so?
Well, they didn't just buy a few vendor licenses last quarter to, appease shareholders. CEO Robin Vince noted that more than 2 years ago, BNY became the first global bank to deploy a DGX Super POD.
Okay, let's define that, because a Super POD sounds like something out of a sci-fi movie.
It really does.
They aren't just opening up ChatGPT in a web browser, right?
Sure from it. A DGX Super POD is a massive data center scale AI supercomputer built in collaboration with NVIDIA.
Wow.
Yeah, it is foundational raw compute power. By bringing that infrastructure in-house, BNY built their own proprietary enterprise AI platform, which they call Eliza.
And here's the stat that blew my mind when I read this. They gave 100% of their 47,000 employees access to Eliza.
Every single person.
Right. And they currently have 218 distinct AI solutions in production right now, which is up 4 times year over year.
Yeah, the adoption rate is staggering.
They're even deploying what they call digital employees. These are multi-agentic AI solutions working alongside human colleagues.
And that term, multi-agentic, is critical to understand.
Okay, break that down for us.
It means you don't just have one AI spitting out an answer to a prompt. You have multiple AI agents talking to each other to execute complex workflows.
Give me a real-world banking example of how that actually works, because it sounds a bit abstract.
Sure. Imagine a massive 500-page corporate loan agreement.
Okay.
In a multi-agentic system, Agent A is designed purely to read and extract the legal covenants.
Right.
It passes that data to Agent B, which cross-references the bank's internal compliance rules.
Okay, so it checks the work.
Exactly. Then Agent B flags any discrepancies to Agent C, which drafts an executive summary for the human loan officer. Yeah, a process that used to take 3 analysts an entire week can be executed in seconds. The CEO literally refers to this AI integration as a superpower that creates a capacity multiplier.
Okay, I have to push back here, though.
Fair enough.
You and I read these corporate reports constantly. Literally every company on Earth right now is putting out press releases claiming to be an AI-first company.
Oh, absolutely. Everyone wants that valuation.
Everyone wants that massive tech valuation bump. So beyond the cool factor of, digital employees, is BNY actually seeing real financial benefits from this, or is this just corporate buzzword bingo to keep Wall Street happy?
It is a totally necessary skepticism. But the evidence in this transcript points to structural operational changes.
Okay.
The CEO outlined a very specific triple play of AI benefits that directly feed that insane operating leverage we discussed earlier.
Let's hear it.
First is capacity creation, which is pure productivity.
Right.
Fewer manual touch points mean fewer errors, which lowers compliance costs and drastically speeds up cycle times.
And the second part of the triple play.
Revenue enablement. They aren't just using AI internally, they're embedding it into the software and platforms they provide to their clients.
Oh, interesting. So it's outward facing too.
Exactly. Better tech wins more external business. And the third piece is expanding the firm's perimeter.
Meaning what exactly? Like taking on entirely new industries?
Not necessarily new industries, but new tasks within their existing industry.
I see.
Because AI gives them an abundance of operational capacity at a very low marginal cost, they can now profitably take on complex client requests that previously would have been way too labor-intensive or expensive to justify.
So they are essentially changing the math on what makes a profitable client.
Precisely.
But how did they manage to build this without getting crushed by the costs of the AI models themselves?
Right.
Because compute is not cheap.
No, it's not. But that is the real strategic advantage of scale. BNY has a massive $4 billion annual technology spend.
Ah, I see. And the CEO specifically mentioned they want to avoid getting trapped in an external vendor's ecosystem, right? Becoming subject to, like, token price wars. It's the difference between building your own solar grid versus relying on the electric company during peak surge pricing.
That's a perfect analogy.
Because if you're a mid-sized bank, you are entirely at the mercy of whatever the major cloud providers decide to charge for AI access next year. BNY just has the capital heft to build the factory themselves.
It creates a massive competitive moat. The upfront cost is astronomical, sure, but the marginal cost of running it approaches zero over time.
Which leads us directly to the next critical question.
Okay.
It is great to have internal digital employees saving you money, but how does this multi-billion-dollar infrastructure translate into dominating the market and actually winning over highly demanding clients?
Well, the proof is in their record sales quarter.
Right.
Amazingly, over 50% of the clients who awarded BNY new asset servicing business in the first quarter also bought into at least one other line of business at the bank.
That cross-selling metric is huge.
Massive.
Because once you embed your technology into a client's daily operations, especially in something as complex as custody banking or asset servicing, it becomes incredibly sticky.
Oh, absolutely.
It is very hard for that client to leave, and they are landing massive new logos because of this tech.
Yeah, they really are.
The transcript highlights Allianz Global Investors, which is, one of the world's leading active asset managers. Allianz specifically chose BNY because they wanted direct access to BNY's AI and modern data infrastructure to modernize their own operations.
Yeah, and we also see major tech players migrating to them. Like PayPal chose BNY to provide institutional-grade digital asset custody for their global network.
And there's another really interesting one here. The transcript also highlights a major government contract. The U.S. Treasury selected BNY as the financial agent for the Trump accounts. And just looking purely at the mechanics of the program as outlined in the source material, to be perfectly clear and neutral here, we're just reporting what's in the document. This is a U.S. government investment savings initiative for children aimed at building a financial foundation for the next generation.
Yes, that's exactly what the document states.
So BNY is essentially providing the massive national infrastructure for this program, and they are collaborating with Robinhood, who will provide the retail-facing brokerage and trustee services.
And from an operational perspective, managing the data and infrastructure for a national government initiative alongside a fast-moving retail giant like Robinhood, well, it requires incredible scale and unshakable technological reliability.
So what does this all mean? When you step back and look at the landscape, I mean, Allianz wanting their AI, PayPal plugging into their digital asset custody, the U.S. Treasury and Robinhood using their infrastructure.
Yeah.
Is BNY stopping being a traditional bank? Are they essentially transforming into a massive tech vendor that just happens to hold money?
It is a profound shift in identity. And the CEO actually answered this by pointing to what he calls their mini moats.
Mini moats, okay.
Yeah. On one hand, they have cultivated the clean sheet, innovative mindset of a Silicon Valley tech company.
Right.
But they combine that tech stack with the absolute trust, regulatory clearance, and deep financial plumbing of a global, systemically important bank.
Yeah. Okay, let's break down that term, Global Systemically Important Bank, or GSIB. That isn't just a fancy corporate title, right? It is a strict regulatory designation.
Yes, exactly. It means regulators view you as so deeply embedded in the global economy that your failure would trigger a worldwide financial crisis.
Wow.
And with that designation comes staggering compliance hurdles, immense capital requirements, and intense oversight.
So a tech startup can build a sleek app in a garage, sure, but they don't have the regulatory clearance or the fortress balance sheet to manage, say, $15 trillion in corporate trust debt servicing,
Why?
which is a milestone BNY just crossed this quarter.
Yeah, and that is the mini mode. Clients are coming to BNY because they offer an ecosystem that simply does not exist anywhere else.
It's the best of both worlds.
Exactly. You get the cutting-edge AI and digital asset capabilities of a startup, but you also get the impregnable balance sheet and 240 years of trusted legacy.
But marrying those two worlds really pushes BNY to the absolute bleeding edge of finance.
It does.
Because as they take on digitally native clients like PayPal and Robinhood, they're being forced to navigate the future of money itself. Tokenization, digital assets, and of course the escalating cyber threats that accompany all this exponential technology.
Right, and tokenization is a prime example of their balanced approach.
How so?
Well, CEO Robin Vinces was very clear on his stance. He calls it evolution, not revolution.
Okay.
BNY's strategy is not to force every single asset onto a blockchain tomorrow. Their goal is to act as the reliable bridge between traditional finance and the emerging digital asset ecosystem.
I have an analogy for this because sometimes listening to the intense hype around crypto and tokenization, the idea of putting absolutely every financial asset on the blockchain, well, it feels like trying to bolt a jet engine onto a horse buggy.
That's a great visual.
You're like, does the world really need every single stock and bond to be fully tokenized?
If we connect this to the bigger picture, the CEO made exactly that point.
Really?
Yeah. He noted that highly liquid, transparent markets like trading S&P 500 equities, they are already incredibly efficient.
Right. I can buy a stock on my phone in half a second.
Exactly. The traditional systems work seamlessly. So putting an S&P index fund on a blockchain right now might not actually add any incremental value for the client.
So where does this jet engine actually add value?
In the slower, opaque, highly manual markets.
Like what?
Think about private corporate loans or complex physical commodities.
Okay.
Those markets are full of fiction. Selling a piece of a private loan can take weeks of legal paperwork and manual settlement.
Ugh, sounds painful.
It is. But tokenizing those assets creates an immutable digital record that can be transferred and settled almost instantly.
Oh, wow.
Yeah, it brings opaque assets deeper into the modern financial system, standardizes them, and makes them vastly more efficient to trade.
That makes total sense. You upgrade the buggy where the wooden wheels are literally falling off, but you don't mess with the Formula One race car that is already winning on the track.
Perfect way to put it.
But all of this digital evolution, the tokenization, the 218 AI solutions, the digital employees, it brings us to the dark side of this technological superpower.
Yeah, it does.
Because BNY is not the only entity with access to exponential tech.
No, absolutely not. Cyber defense was a major sobering topic in this earnings call.
I bet.
When you hold the keys to 20% of the world's investable assets, you are target number one for bad actors, hackers, and state-sponsored cyber criminals.
Terrifying.
And those adversaries, they have access to the exact same exponential AI tools that BNY does.
They are literally having to fight fire with fire. The report details how BNY is using an in-house AI program called Mythos, alongside early access previews from OpenAI, to actively defend the financial system.
Yeah, they are deploying their own AI agents to constantly hunt for network anomalies, identify vulnerabilities, and counter the AI-powered attacks coming from the outside.
Unbelievable.
It is literal machine-to-machine warfare happening in milliseconds.
The CEO acknowledged that as technology accelerates on an exponential curve, it is entirely predictable that we will get surprised by sudden step functions in capability.
Yes.
You have to assume the attacks will get significantly more sophisticated overnight, and your automated defenses just have to anticipate that. It is a constant, exhausting arms race.
It requires a culture of relentless vigilance and, frankly, massive ongoing investment.
Which really brings us full circle on this deep dive.
It does.
We are watching a 240-year-old legacy institution prove that the old guard can actually out-innovate nimble startups, provided they have the capital, like that $10 billion buyback and a $4 billion tech spend, and the cultural willingness to actually put AI into the hands of every single employee.
They're completely redefining the mechanics of a modern bank.
Yeah.
But the scale required to pull this off raises an important question.
What's that?
Something for you, the listener, to mull over as we wrap up today. We talked earlier about BNY's massive $4 billion tech budget, protecting them from external vendor lock-in and AI token price wars.
Right, because they can afford to build their own massive infrastructure from scratch.
Exactly. But think about the implications of that for the broader economy.
Okay.
As AI models become the foundational infrastructure of modern business, just as essential as electricity, the internet, or cloud computing, will only the absolute largest mega corporations with multi-billion-dollar budgets be able to survive.
That is a chilling thought.
Right. If a firm needs a massive proprietary AI budget just to defend itself against AI-powered cyber attacks and protect its margins from cloud pricing surges, are mid-sized companies destined to be entirely at the mercy of big tech monopolies?
Wow. That is a heavy but vital thought to leave on. If you look at your own industry through that exact lens, who has the scale to build the digital moat and who is just renting space?
Exactly.
It brings us right back to that grandfather clock we talked about at the beginning. If the clock doesn't have the billions of dollars to suddenly install fiber optics and a supercomputer brain, well, it might just get left behind ticking away in the corner while the rest of the world goes digital.
A stark reality for any business leader navigating this transition today.
Thank you so much for joining us on this deep dive into the BNY Q1 2026 earnings. It has been a wild ride through the absolute bleeding edge of the financial system, and we can't wait to unpack the next big shift with you. Stay curious, everyone.